2023 has been a really good year. The returns has been really good, and now that we are close to year end, we are starting to think about next year. So, what we can expect from the stock market for 2024 here, what kind of scenarios are most probable, what kind of returns can we expect from equities. So if you are curious about that, you have to watch this video. So let's start. So first, I've just read the latest report from Goldman Sachs. They published the 2024 US equity outlook. All you had to do was stay. So in this video, I will react, I will comment in the most important things I've read about this report. So first, let's start with this year. What happened in the 2023 year? So this year we had inflation eased a lot. US economic growth slowed, but the economy has been strong when we talk about expectations. The Federal Reserve appears to be near the end of its rate hike cycle, so rates are about there are not being rate increase expected in the next month or until year end, so we are near the end of the rate hike cycle, and the Magnificent Seven have carried the market. If you look at this graph, this was published in 15th of November. Since then the stock market have been up a little bit, but if you look into the S&P 500, the index is up 17%, while the equal weight is only up 2%. The Magnificent Seven mega cap tech has been carrying the market. So for next year, the most probable scenario or the base case for Goldman Sachs is to end the year, the S&P 500 around 4,700, which is again about less than 5% if you look into the value the S&P 500 is right now. They say our top-down valuation model suggests that a forward P multiple of 19, the aggregate S&P 500 index trades in line with fair value on both a historical absolute basis and relative to interest rate, but is unlikely to expand meaningfully in 2024. The S&P 500 is trading around an average of a forward P of 18, which has been like fair value. In the outlook for the next year, Goldman Sachs doesn't believe in P expansions, and I would agree with that. They are expecting returns to equity around 5%. If you look into these expectations, but rates at the moment are around 5%. So the 5% return risk-free in cash remains a competitive alternative. So this is what we have to do now. We have to look into the future. When you look into a term of risk-reward, is this a risk-reward you want to take? We have to be looking into it in more depth. But when you look into rates around 5%, you can have a risk-free return of around 5%. If you want to invest in equities, for example, you have to have a higher return on that. You have to want 8% or even 10. Bear in mind, I always want to have more than 10% rate of return. For example, that's why I always use a discount rate of 12% for my base case, for example. If I want to invest in equities, I want to have a better return than the overall market, for example. And look into that. If this is true, this is only a gain of around 5% for the next year. So a risk-free return on rates might be a really compelling alternative. When you look into the outlook of the Magnificent Seven, bear in mind the Magnificent Seven carried the S&P 500 this year. So when you look at the Magnificent Seven, are up around 71%, while the other companies are only up 6%, while the overall S&P 500 is up 19%. At the moment, the Magnificent Seven, the 7 largest companies, have 29% of the total market cap of the S&P 500, and at the moment there are if you look into the equal weight, the average P of the index is around 14%, and the Magnificent 7 are trading at a higher P, that they have a premium, and that's, I do believe, in my opinion, it is correct, because the Magnificent 7 are really great companies, they deserve a premium, they are growing at a faster rate than the other 493 companies in the index, they have better margins, so they deserve a little bit premium. So this is, and bear in mind why that happened, why this year the Magnificent 7 are going up more than the rest of the company, because in the last year they were down more. For example, while in the last year the Magnificent 7 were down 39%, the remaining of the S&P 500 were down only 11%. Now this is the inverse correlation, and they are up a lot more, and they recover, while the other companies are just up a little bit. But it is like an equilibrium, balance. So will the Magnificent 7 mega cap continue to outperform the remainder of the S&P 500 for the next year? Maybe, because there are better companies, better margins, higher growth, but the risk reward of this trade is not especially attractive given the elevated expectations. So they are trading at a higher premium, because the market is expecting more from these companies than the rest of the companies in the index. So the key determinant of whether the mega caps will continue to outperform next year will be our realized sales and earnings growth compared with the current expectations. So I've read in this report, it is expected the Magnificent 7 to grow the revenues around double digits, around 11%, while the other companies on the S&P 500 it is expecting to grow around 3%. So they have to meet the expectations. If that didn't appear, they will trail the rest of the index. If they could continue to grow a lot, double digit, margins expanding, they will be continue to have a higher PE. So there are a risk reward. Should you invest in the mega caps? No one knows. You have to look into that, and if you liked it, and if you believe they can meet expectation and growing at a higher level than expectations, or having better margins than what is expected, this will be a really good trade, and you should invest in one of the Magnificent 7, for example. What are the scenarios? Goldman Sachs tell us this is their 4 scenarios they are expecting. I do agree, I like these scenarios. I just don't agree about the slower growth and higher yields, because if we have a slower growth, I do not believe that we will be higher yields, because the only way that we'll have higher yields and the Fed starting to increase rates again, it is only if inflation spikes, and if the growth slows, this is deflationary, and I do not believe the Fed will hike rates because the economy is slow. It will be the contrarian. If the economy is slow, they might decrease rates so they can stimulate the economy. But this is but the rest, my baseline of 5% growth, I do really believe it is a really good and the most probable scenario. I like the odds, for example, and the probability, and I do agree if they have these earnings per share growth, for example. We still might have a recession. They only attribute the probability of 15%. I do agree with that. We can be down a lot if the growth slows. I do not believe we will be down as much, but this is Goldman Sachs' opinion. In my opinion, I do believe we could have a higher P, but this is good scenarios in my opinion. Not for year end, for example, because I always think the market thinks ahead, like 6 months, 9 months. We don't know, no one knows, but will be the targets for mid-year, for example. If it is expected the earnings per share to grow at 5%, at June we will be trading that. when we'll be at year end of the next year, we'll be already trading what are expectations for the next year. But this is just the scenarios. We don't know what will happen in the future. We can have a faster growth and yields going down. We can have a PE expansion to around 19 as Goldman Sachs is expect, or even 20 or 21. It could happen, and you can have like 5,000 or 5,500, for example. It could be higher, and you can have a better return, like 15%. The economy can grow faster. AI can we can have an increase in productivity, for example, and we can have the economy growing a lot, for example. But the growth can slow because we are having higher yields for a year now, and the economy is remaining really strong. But this is really difficult for companies to hold these rates, and it could take a hit on the economy, and we can have a slower growth or even a recession. The probability of that at the moment is low, but it could happen. But if you look into the baseline of Goldman Sachs, they are expecting 5% growth in the earnings per share, and if that happens, they are expecting the PE to maintain equal as it is this year. So if that happens, we'll have higher return, only 6%, which when you compare, or when you look into the risk reward, it's not great, because you have rates around that price, and do you want to invest in equities only to have a return equal of the risk free? No, because you can have a recession and you can lose a lot of money. But this is the most probable scenario. We can have better growth, and if that happens, we can have a better return. So just to end this video, we talked about the scenarios. This is the most probable scenarios for Goldman Sachs and what they think it could happen in next year. But at year end, they will be already thinking about the 2025 year. If a recession happen in the next year, when we hit the recession, we already have passed, and we already be trading at next year's earnings, for example. It's always complex, and we shouldn't take too much attention to this. I know I'm talking about that, but this is just probabilities and scenarios. In the end, you just have to buy companies you do really believe that are undervalued. You shouldn't be always taking or thinking about macro scenarios. You want to invest in equities, good companies, and invest for the future and for the long term. But this is just what the research from Goldman Sachs is telling us. They are bullish on the next year. They are not expecting a recession. Their most probable scenarios, they are being conservative on earnings per share growth, for example, and it could be better. We can have a PE expansion, we can have high returns, but since this year has been really good, the risk reward for next year will be lower. So it will be really difficult for equities to outperform the rest of to outperform this last year, this 2023 year, since we are up a lot. It has been a really good year. For next year, I don't want to think about that. I just want to continue my research, bring the best content to you guys, and this is just a report of Goldman Sachs research that was published on 15th of November. Really good things we can take from that, and it's always good to look into the future and what are the most probable scenarios. So I hope you find this information useful, guys, and if you find it, please like and subscribe. Bye.